I got a great question about real estate capital gains taxes from a viewer named Brett. Here's his situation. He currently lives in Colorado. He purchased a home back in 1997 for $160,000. It's his primary residence. He and both his wife live in that home, and they're now under contract to sell the home for $555,000. They're making that move from Colorado to the Huntsville area, and their question is, are they going to have to pay capital gains taxes? Because they're basically saying they want to hold back $50,000 of this gains to put towards the furnishings of their new home, and they don't want to have to pay taxes. First, I'm not an accountant, so make sure you double check with your tax accountant about this advice for your particular situation. So there's a couple of things that Brett will want to consider in this. Number one is the tax laws show that you have to live in that home at least 2 of the last 5 years for it to be considered a non-taxable event. So that's one of the layers that the IRS looks at. So living in that home as your primary residence for the last 2 to 5 years. The second thing that they look at is the amount of gain. They give you a $250,000 tax-free gain if you're a single, and up to $500,000 if you're a married couple. So for Brett's situation, he lived there for more than 2 years. Lived there in 1997, selling the home in 2022. So that satisfies that condition. In terms of the taxable amount, I think he said he sold his home for $555,000, bought it for $160,000. That's a $395,000 gain. Since he is married, that is less than the $500,000 allowable deduction. So Brett, none of your income from this sale should be taxed again. You want to check with your tax accountant. So let's look at a couple of the other versions of this. So let's say Brett was not married. So if Brett was not married, his maximum deduction would be $250,000. So everything above that $250,000, which would be $145,000, $395 minus $250,000, would be considered taxable event for Brett. Now, the other thing that could happen as well is, let's say Brett lived there for less than a year. So if Brett lived there for less than a year, then that entire amount, that entire gain would be taxable. And then the other scenarios, if he lived there between a year and less than 2 years, then in that case, it would be considered what's called a short-term capital gains, which means he would pay a lesser tax rate on that gains.